You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it is Thursday. It is 1:30 p.m. Central, 2:30 p.m. Eastern. It is time once again to peer off into the world of futures options, see what's moving in the realms of energy, rates, metals, equities. Who knows what the heck's going to make it on the show today? That's why you have to tune in every week. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-compelling, at least we think so, Options Insider Radio Network, reminding you whatever content you're getting, including TWIFO, but not limited to TWIFO, whatever platform you're getting it on, iTunes, Audible, Spotify, Podbean, wherever you get it, we don't judge. Keep rating and reviewing. It really does help new folks discover the content in these crazy, certainly tumultuous these days, markets. Of course, keep those questions and comments coming, too. We do love to hear from all of you guys and gals out there. Let's see who we're hearing from on the old program today. I'm pleased to be joined once again by my old friend, Mr. Sean Smith, the Managing Director of Derivatives Licensing, this time holding down the fort in the FTSE Russell mobile studios. Mr. Smith, welcome back to the program, sir. And where are you hanging your hat today?
Mark, it's great to be on the show. Thanks for having me. Perfect. I am in Florida from the FTSE Russell studios, my mobile studio, as you put it. And it's we're about to get a lot of rain here, but it has been quite sunny and beautiful for the last couple of days. We got here a couple of days ago.
If there's a day that ends in Y in Florida, chances are you're going to get some rain at some point during it. It's kind of just like clockwork. It's like whenever we go down there, around somewhere between 2 and 4 p.m. is when the thunderstorms roll in for a couple of hours. And then also joining us, holding down the CME Group hot seat today, once again, a returning guest, Mr. John Brady, the managing director over there at RJ O'Brien. John, welcome back to TWIFO, sir. It has been too long.
Thanks, Mark. Thanks for having me. Hello, Sean. How are you guys? Hope everybody's well.
Great to have you on the show, John.
We are well, and it is time to kick things off the way we like to do. It is time for our movers and shakers report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody, time for the Movers and Shakers, a portion of the show where we break down what's moving to the light side, a.k.a. the upside, and to the dark side, a.k.a. the downside over there at CME across the broad spectrum of all the products that are trading over there at CME these days. This week's report, a little bit more bifurcated. We got pretty much equidistant to the upside and to the downside. This is the first time we've seen a roughly 50-50 report in quite some time. Seems like they're always biased in one direction, at least 2/3 in one direction or the other. A lot of the times lately has been mostly to the upside. This week, probably a lot of it on the heels of what we've seen earlier this week with broad sell-offs across a lot of different spaces in the commodity and equity realm. Again, going back to that conversation we've had before, listeners, about cross-asset correlation. When it all hits the fan, correlation tends to move to 1. So keep an eye on those cross-asset correlation tools over there at CME if you haven't checked them out. So John, you know how this game is played. You're our guest in the CME hot seat, so I will allow you pride of place. Where should we begin our journey this week? To the light side or to the dark side, sir?
Why don't we try the light side?
All right, let's do it. I knew there's a reason why Sean liked you. He's very much a diehard light side guy as well. Let's go to the light side. Number 5 to the upside this week. Again, this is 7 days since our last show, listeners. So what's been moving and shaking since our last show? Eurodollar is looking to the light side, up 3.03%. They were in the exact same spot last week, number 5 to the upside as well, but they were up nearly 7% last week. So a good couple of weeks out there in Eurodollars land. Number 4, soybean meal. Going back to the beans, this time the meal, up 3.11%. Number 3, out to the livestock again. Feeder cattle, up 5, almost 5.25%. It was number 4 in the other direction last week, off 2.62%. Number 2, once again to the beans. Soybean oil this time, up nearly 8%, 7.94%. So a good run for the bean, at least the bean components out there this week. And number 1, with a pretty impressive bullet, iron ore. Haven't talked about that one on the show in a while. Up 10.5% almost this week. So quite the rampage here this week for iron ore. Let's go to the dark side. It was kind of a fight for who can make it into our bottom 5. The Russell 2000 just barely getting squeezed out. It falls at a number 7 with almost 3% to the dark side, 2.81%. It was number 3 in the same direction, off 3, about 3.25% last week. So interesting couple of weeks to the downside in Russell 2000. I'm sure Sean will have some interesting nuggets to share on that in a little bit. We got number 5 here this week is the NASDAQ 100, off 3.08%, so just barely beating out the Russell 2000 to the dark side. Number 4, one of our former winners. It's been winning for quite a while. Corn finally taking a break this week, off 3.16%. It was number 4 in the other direction last week, up nearly 7%. So it's been a good couple of weeks for corn this week, taking a bit of a break. Number 3, palladium. Another one doesn't make it on our list very often, off 3, almost 3.5%. this week. Number 2, jumping up a bit to KC Wheat. Again, more of the ags taking a break this week after their incredible run-up the last couple of weeks, off 6.3%. Number 1 to the dark side, you could probably guess what it is, listeners. If you had to pick a week and pick a winner in one direction or the other, if you guess Bitcoin every week, there's a good chance you might be right. This week, you are the winner to the downside, off 10.09%. It was number 3 in the other direction last week, up 8.2%. So, crazy couple of weeks here for Bitcoin. Musk coming out after he talked it up for a lot of Q1 and bought it with Tesla, now coming out and saying, maybe we don't want to take any more of this because it's hurting the environment. So he talked it up, talking it right back down. It's off, at least it was off nearly 12% last I checked earlier this morning. So crazy madness afoot out here. Also contributing to some of the vol advancers on the week. Bitcoin leading the upside on the vol side. Again, not that much. Bitcoin vol has kind of been an interesting story of late. It's been languishing. I'll have to see where it is right now. But coming into the start of this week, it was still in the mid-70s, which is pretty low for Bitcoin. It got down to about 69% not too long ago. So getting into a 60 handle on Bitcoin vol is pretty anemic. Right now, it's back up. That front contract in June, up about 3% on the week. So not a ton. That's a little bit more juice, followed by number 2, vol advancers, We've got the live cattle August contract up about 2.4%. And then Brent August contract bringing up the rear there, up 2.2%. But now let's keep on rolling. We got a lot to parse here on the show today. John, you are our guest, so I will allow you pride of place. What do you want to sink our teeth into first on the show this week? Does something on our movers and shakers catch your fancy, or is there another product category you want to start off in first?
Well, so on the movers and shakers, right? I mean, your dollar is obviously kind of being up on the week, right? I think that's mostly kind of a function of obviously a payroll report that I think was disappointing across most market participants' views. But Mark, I think that trade specifically. I mean, look, a lot of the stuff on the lighter side, right, continues just to sort of suggest or manifest the trade of the reopening, right, and the reopening going on not just domestically, but now starting to be picked up, in the UK and in continental Europe and things like that. So I think that's kind of what we're seeing. Bitcoin, I think on the downside, I think Bitcoin is kind of reflective of a little bit of Fed policy, inflationary pressures. We can delve more into that as the show goes on. But I think that in regards to Eurodollars and why they were up on the week, and this is a theme that I think we're going to kind of maybe explore a little bit more here over the next hour. The trade there is reflective not just of the soft employment number. I would argue, and I think some significant customers out there, some large capital, large pools of capital would argue that we are at a dynamic time within this economy and within this economic recovery, and specifically as it speaks to the volatility of the economic data moving forward. Over the course of the last 4 days, we've seen an employment number that didn't miss. It really missed to the downside. And then yesterday, we saw a CPI number that didn't miss. It missed big to the upside. And I think that over the course of the hour, I think you and myself and Sean are going to have a great discussion about how the volatility of economic data is really going to drive the trade this summer. And I think that manifests itself very clearly in the performance of Eurodollar futures last week.
I agree with you. It's like we were simpatico here, John, because I already have Eurodollar split up as we begin our journey in the rates.
The Fed, the yield curve, inflation fears. How are they impacting options activity and volatility in your favorite interest rate products? Let's find out as we explore the world of rates.
All right, everybody. Welcome to the world of rates. A lot going on out there over the last couple of weeks. We had Yellen coming out last week and spooking everybody, trying to put her old Fed chair hat on again, talking about raising rates out there. That spooked everyone for a while there. It seemed like the market recovered towards the end of last week. As John mentioned, this one kind of surprised me. We had, as he alluded to, not just a miss in those jobs numbers. It was catastrophic. They were expecting about 1 million new jobs. They got about 250,000 instead. So they were nowhere near the ballpark. And yet what did the market do? It exploded to the upside and vol came crashing in. Of course, fast forward to this week, we had the kind of 1, 2, 3 punch of Israel and the conflict over there. We had strong, aggressive inflation numbers here in the U.S., which again, can't really come as a surprise to anyone. And then Musk adding a little fuel to the fire by talking down crypto. And now all of a sudden the sell-off was hot and heavy this week, vol exploding, a lot of craziness. So there's a lot of vol to be found out there. But let's start in the land of Eurodollars and indeed in rates, John. What's been catching your eye out there? And were you as surprised as I was last Friday when we saw these pretty darn bad numbers and the market just ignored them and exploded to the north, sir?
Yeah, so a couple of thoughts there, Mark. First of all, the initial reaction by the market, which saw treasuries and Eurodollars richen, i.e. prices going higher and yields going lower, was kind of as expected. But, as the day went on, market participants, began to kind of rethink that with the idea that perhaps the number wasn't, or really the job market is not as weak as the number portrayed. It's one single data point. and payrolls is very prone to revisions. And this number will most likely be revised higher. Real-time data, such as jobless claims, continues to suggest that at the state level, that claims continue to drop. Claims came in just this morning at 473,000 from an expected 490,000, while continuing claims dropped to 3.655 million from last week's 3.7 million. So, look, there are other signs out there, jolts on Tuesday with over 8 million job openings. There are other signs out there. The employment subcomponents of ISM and non-manufacturing ISM suggest that the labor market is much stronger than just last Friday's data point, which again tends to be revised and greatly revised. That having been said, I think that in Eurodollars and Eurodollar futures and options specifically, a lot of the macro trade has been in what we call mid-curve blue Eurodollar options. So that would really kind of be for your listeners kind of at home, Mark. That's really kind of those are options that expire in calendar year 2021, maybe into early 2022, but they go up against contracts in June of 2024, September of 24, December of 24, and March of 25. And so from a rates perspective and trying to kind of keep the building blocks kind of as easy as possible, that is kind of what we would call maybe the 4-year forward LIBOR curve. And the duration dynamics of that part of the curve, that forward LIBOR curve 4 years out, is kind of similar to, kind of the duration point of a 7-year note. But the advantage of Eurodollar options, these mid-curve options, these blue options struck against these 2024 contracts, as compared to the Treasury complex, is that you can hold these mid-curve options for 3 months, 6 months, even 9 months, as opposed to Treasuries. So, for example, like right now, we're just beginning our roll period from June into September. 10-year Treasury notes, right? So really, you can buy and hold options against the September contracts that expire end of June, end of July, and end of August. But if you want something for December or November or something a little bit further out, the Eurodollar options, these blue options, are the place to be. And large macro names, very large macro names, have been very busy accumulating downside put spreads, looking for a higher yield trade in Q3 and Q4, and they've been selling calls and call spreads against buying these puts and put spreads, and what strategies kind of known as a risk reversal, with the idea they're using the premium sales from the call spreads to finance their long positions and put spreads. So some of the more tactical names or the larger pools of leverage capital in here sort of have the view that as summer turns into fall, the economic data will remain hot, it will remain strong, and inflationary pressures may not actually end up being transitory. And there'll be a rethink. So, for example, 21 Delta blue September 98 even puts trade right around 5.5 ticks here. They have open interest of almost 500,000 contracts, about 475,000 contracts as of last night's 4 p.m. close. They carry about a 21 Delta, and they go through the middle of September. And most importantly, Mark, they cover the Jackson Hole Conference in late August. So the options there cover Jackson Hole, whereas in the Treasury complex they don't. So again, so the trade has really been the accumulation of these puts or these payers, payers and using swaption terminology, looking for higher rates later on in the year, and the depth and liquidity of these options has been nothing more than just very impressive, very large. People can get things done. The trade's been very good, very solid, tight markets, and it's been a good trade. And I think that's really sort of the main theme going on in Eurodollar futures and options right now.
Let's check out some of those main themes out there in Eurodollars. You guys, as always, can follow along for yourselves, listeners, completely free. CMEGroup.com/TWIFO or CMEGroup.com/TWIO. This week in options, both of those should work. They'll get you to where we're looking right now. You'll see a big drop down there, all the different products. Go to rates, go to Eurodollars, and then be warned. This is probably the most active beast over there at CME. There, if you hit select all for all the months and all the strikes, you will be scrolling for days. Just be prepared. As John kind of laid it out, they have expirations going all the way out pretty much 10 years here on this product. So a lot to unpack here, a lot to look at here in all the months and strikes. Let's look. Coming into today's show, the volume actually not blowing the doors off. We've seen Eurodollars get up there upwards of 5 million in the past. This week, about 3.2 million on the tape right now. So an active week, but perhaps not the Rock'em Sock'em Robots week some people were expecting. Now we're talking about dozens of months and to look at here to parse. So the lead month, the most active month, still has a fraction of the paper, not even 15%, 14.9% in that June contract coming up here in the greens. That has about 30 days to go. I know it's confusing when you first encounter the Eurodollars listeners. How they have expirations going out years, but still are pretty much every month. There's still a March going out for many years. It's very confusing. I get it. Maybe we need to have a whole show one day just about the mechanics, the underlying mechanics of Eurodollars, because it still is a very important product, as witnessed by the fact that it's kind of the last of the Mohegans over there right now from an option pit trading perspective over there at CME. And of that contract, doing about 15% of the paper this week, that June contract that has about a month or so to go, about 29 days to go. It was the 99.1875 puts. By the way, we're at about 99.38 right now out there, listeners. They did nearly 100,000 contracts, 99,662 to be precise. No paper today, which is surprising. Almost all that coming on Monday, 88,000. Again, that's more paper than we're going to see in some entire complexes. You can look at an entire metals complex and not see 88,000 contracts in total, let alone in 1 month, in one contract, and just a put in one day on Eurodollars. So Eurodollars can do some paper. Of that, 61,000 of that was opening. So that's a lot of opening paper out here in the Eurodollars. 99.1875 puts. The rest of the week is almost a rounding error when you have 88,000 going up on Monday. That's followed hot on its heels by the 99 3/8 puts over there as well, doing about 72,000. Again, the big day was Monday, about 54,500 there. So coming off the heels of the number on Friday, coming out of the weekend, we saw a lot of paper here hitting the tape on Monday in the Eurodollars. Actually kind of quiet later in the week, which is probably why we're not seeing a number closer to the 4 to 5 million volume mark right now. Sean, any thoughts here on, you're an old school rates guy, any thoughts on some of this rates action we've been seeing over the course of this past week? And what do you think about that idea? We haven't really done that on the show before. Maybe one day just doing a deep dive into the mechanics and nuances of Eurodollars for all of our listeners who are just terrified at the prospect of, maybe I'll have to bring John back for that. What do you think?
I think that's a great idea. But just to circle back, I think John made some really, really good resonating comments in regards to this, the data that's been coming out as of late and how the numbers have been reacting. These economic numbers have been mixed, and the revisions revert some of the numbers, as John also mentioned. There's been some inflationary numbers. There's been some slowdown of the economy numbers. There's been really positive economic numbers washing with some negatives. GDP a couple weeks ago, CPI, as John mentioned just a couple of minutes ago, was way higher than expected. But there's these blips in the economy that are causing these numbers and these blips. So I think things will come down. I see the volatility as being what I like to call healthy vol, because it is absolutely tradable. As John said, these markets are deep and they're liquid, and you can always get your trades done in the Eurodollar complex. And that hasn't changed, since it was open outcry. That was, back in those days, you still got everything you needed to get done. So the pit, or I should say, the Eurodollar complex now being electronic is deep and liquid. Options are still open outcry, of course, but just incredible liquidity and depth in that market.
Where else there's incredible liquidity and depth, and I'm sure a lot of you have questions, have been paying attention to quite a bit this week because it's been very tumultuous, and it's certainly lighting up our movers and shakers this week. It's the equities, so let's get to it.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody. Welcome to Equities. You guys can follow along with this as well. Same deal. Go to the drop down, get out of the rates, go into the equity indices, and then pick your poison here. We're going to start in Russell 2000. You can hang your hat pretty much anywhere. By the way, if you're new to the show, these reports are running all the time, 24/7. You can go in there at 2 a.m. on Saturday night if you want to check your fluid milk. We won't judge. Just check it out. The reports are always there for you, always calculating, always running. So you guys can get access to those. It's a great bonus. If you're listening to TWIFO, if you're trying to learn about these markets, you really have no reason not to check these out. This is kind of the only game in town for this depth of analytics on the futures options front. There aren't many sources for this. Unlike the equity markets where there's a lot of places offering you analytics there. On the futures options side, not many. You got Nick and his team over there, Quick Strike and Bantix, really kind of doing yeoman's work. So you folks should check it out if you're even remotely intrigued by any of you can't beat the price. And if you like it, you can always upgrade, get some more bells and whistles on it. Speaking of bells and whistles, John mentioned the volatility of economic data. That in and of itself is driving a lot of broad market volatility. We have numbers here for kicking off the show. We like to start equity analysis looking at volatility because it's kind of hard to talk equities without talking the flip side of that coin, which is volatility. Of course, since then, we had a listener on our last show ask about, is the CDC about to announce repealing some of their mask mandates? And if so, what impact will that have on vol? It seems like they're coming for vol now. CDC did just make that announcement, so we have to re-rack these numbers later in the show and see how these were. But coming into the start of the show, we had our old friend RVX, a.k.a. the VIX of the Russell 2000. Sean, how long have we been saying? It couldn't get below 30. Then once we were below 30, we're like, maybe it can get back above there. Sure enough, it did this week. This big sell-off drove us back north of 30, nearly 33, 32 and about 3/4, up about almost 5 points, about 4 3/4 points from our last show. It hit a high of nearly 34. That was just today, 33 3/4. So it's already come off a point from its high. So it was threatening 34 earlier today, Sean. So small caps getting volatile. VIX coming into showtime, 24.86, puts it up about 5.5 points. Hit a high of nearly 29 today. Of course, looks like that's coming off now as a result of some of that CDC mask vol getting squeezed out of the market. VVIX, which is the volatility of volatility, you know that's going to be higher at about 133.5. That puts it up about 22, almost 23 points. This is back to the levels of vol listeners that we saw back during the madness of the pandemic. We were north of 120 for most of the pandemic season, and now we're back in that elevated and frothy level again, listeners. And vol Q, how long have I been saying, man, NASDAQ vol can't really catch a bid. It's glued to 22. Caught a bid this week up to about 26.5, puts it up about 4 1/4 points from where we were this time last week. So let's break down some of those spreads. The large cap to small cap vol spread, aka the VIX to RVX, a little bit shy of an 8, about 785. That's about 3/4 of a point tighter than it was this time last week. And then we have the VIX to vol Q, so the S&P 500 to the NASDAQ at about a little over 1.5, about 1.6 points. That's more than a point, about 1 1/4 points tighter than last show. Probably a lot of that driven by the fact that vol Q is finally moving. It was kind of glued at 22 while VIX kept bouncing around. Now they're both moving, so that's going to change that spread a little bit out there. So, Sean, a lot to unpack. Let's start with you because small caps have been just blowing it up out here of late. A lot of folks are asking questions about what's going on in the realm of small caps, what's driving this sell-off. I know you and the research team over there at FTSE have been doing a lot of research into this, sir. What's been lighting up your tape in small caps these days?
So thanks for mentioning our market research, folks. Philip Lawler, our head of research, has just put out a couple of nice blogs in the past week on what's behind the recent Russell 2000 underperformance. I would still consider that performance, but the Russell 1000, our large cap index, has outperformed the Russell 2 as of late. But also another blog on how U.S. stocks and our Russell 3000 complete complex, looking at large caps in particular, how they've outperformed the rest of the globe in terms of growth versus emerging markets and other places around the globe. So please go to our website and check out. And as a matter of fact, you could actually come to TWIFO and take a look at these reports as well, right, Mark? I'm sure they can take a look at them there. But Philip Lawler has put out just some fantastic economic data in regards to what's causing large caps now to outperform small caps in the recent couple of weeks. And, it's that tech stock weight in the large caps that has really kind of catapulted. We just went through some really, really strong numbers in terms of earnings with a lot of these stocks in these indexes. And on the tech side, you had some strong earnings. As you know, the Russell 2000 doesn't have such a strong tech weight in it. It's much more diversified into consumer products and services, healthcare, travel and leisure, banks, personal goods, retailers. So there's this mix of real domestic U.S. stocks that drive small caps here in our Russell 2000 index. And when you have the big kind of a shift from these types of stocks to the more growth stocks, like the tech sector within the Russell 1000, you're going to see this outperformance, and it's happened. But we're still looking at fantastic performance from our entire Russell suite, and it's been fantastic. Not to mention the liquidity, as we've mentioned earlier in the show, has been unbelievable in the Russell 2000 futures and options and micro futures at CME Group. The volumes are just looking fantastic. So customers are having a fantastic experience getting in and out of those markets. And the growth on the SIBO mini Russell options has grown as well. So we're really excited to see that traction. Customers are able to hedge. Customers are able to make a statement in equities. Investors are being able to use these products to gain access in and out of the market. So with the movement in our Russell suite, more particularly the volatility that we've been seeing in the Russell 2 based on some of these recent economic numbers, I'm not surprised at all. It's a very strong market, and I think, as John mentioned earlier, some of these numbers are definitely going to settle down. And with the slowdown in growth that we've seen, I think we're going to just continue to see our economy strengthening and turning around. And again, that's economic stimulus, and that's, post-COVID, things are just looking up and up. So that's kind of my outlook as of right now.
And John, I know a lot of your clients over there at RJO are also slinging the equities. You kind of mentioned earlier in the show, inflation, a big driver of everything we're talking about out here. People have been suspecting this for some time, given how much broad fiscal spending we've been pumping into the economy for the better part of the last year. Now we're starting to see the numbers to back that up. So I'm curious your thoughts on, the inflation trade, how it's impacting equities, and what you're hearing and seeing from the equity clients over there at RJO these days, John.
Well, Mark, there's a lot to say. So let me kind of get right to it. Politicians and policymakers did not bring the bazooka out this time when the economy sort of closed down in February, March of last year. They actually brought out a shoulder-held rocket missile launcher because the response, both from physical and monetary authorities, was quick and incredibly powerful. That having been said, the challenge that we're seeing here right now is that how you doing? Is that we're kind of policymakers and politicians can sometimes fight the last battle this time around. What do I mean? In 2007, 2008, when the economy collapsed, that was a balance sheet credit-related collapse. Banks got out over their skis regarding mortgages and mortgage lending. Consumers got out of their skis, got out over the skis regarding mortgage lending and house prices and borrowing, whatever else. That didn't happen this time around. This was a shutdown because of a global pandemic, but balance sheets, both on the financial sector and banks, as well as on the consumer side, were very, very healthy. Were very healthy. And what policymakers have thus done now is they have taken strong balance sheets and strengthened them even more. And nothing shows that better than the U.S. personal savings rate as a percentage of disposable income, which is at all-time highs and is poised to go even higher given all the fiscal stimulus that's coming through. And so the challenge now, and there is a conclusion here, but the challenge now is that this is not the 2008, 2009, 2010 economic recovery. This has the potential to be a much different recovery because because consumer and bank balance sheets and corporate balance sheets on the whole are much healthier than they were in 2008, 2009. Yet now they're flush with cash and income from Uncle Sam's largesse. And so the potential for inflation, significant inflationary pressures, wage pressures coming through as corporations are looking to hire people whose incentive structure may have changed given the generous weekly jobless claim benefit checks they are currently receiving and may receive it through September, if not longer. Look, you're going to see some wage pressures in here, and it's going to get rather interesting. And that's going to be difficult to capture in the data. And that goes back to kind of my earlier point, and that is the data is going to get much more volatile, which means that from a futures and options perspective, Mark, Sean, it's going to be a gamma trade. It's going to be the type of trade where the market, let's say like last Friday, for example, bonds rally, prices richen, yields yields drop, and all of a sudden there's a reversal during the course of the day. Same with CPI, right? The blues were down yesterday 10 ticks. They're up 5 today, right? It's coming back the other way. So gamma is going to be a much more important part of this quote recovery trade, but it's as we come out of this out of the economic slowdown, but also too gamma and optionality, right, is probably mispriced because econometric models that we currently have aren't going to be able to accurately capture the fiscal largesse that's come through on healthy balance sheets, and thus the data is going to get a little bit kooky and a little bit crazy. So from a short term, from a medium term perspective, it's the long gamma trade that I think a lot of guys are starting to hook onto. Traditionally, selling of options has been a winning trade. It's kind of the insurance company model. You sell enough insurance policies, you'll be okay. Well, selling options has been traditionally a pretty good model as well. I think we're at a significant shift here. I think we're at an inflection point, and owning gamma and owning volatility is going to be the right trade.
Yeah, it's certainly hard to argue with that. Institutions may be grokking onto that now. Retail has been on that long gamma trade for a while now, ever since the recovery began. How many times have we mentioned on this network the explosion in options volume in 2020 and subsequent numbers we've seen so far in 2021? A lot of that coming from the retail sector, a lot of that concentrated in a handful of long gamma premium buying type strategies. It seems like everyone and their mother can't buy enough calls out there these days. So there is a lot of long gamma, I should say, out there in the markets right now. Even our current poll, I think, looks like folks are actually, I won't give away the secret sauce for that one. We'll get to that in a little bit later in your feedback segment. But yeah, you're right, John. A lot of long gamma, and it's kind of hard to argue with it given what we're seeing out there in the markets right now. Speaking of what we're seeing, head on over to the drop down. Listeners, go to equity indices, pull up the E-mini Russell 2000, and you'll see what we're seeing right now. A hot week out there, nearly 30,000 contracts on the tape already. Now let's see. The most active month is the June contract, has nearly 30% of that paper, listeners, about 28%. The Russell 2000 right now at about 2162 coming into showtime, off 105 handles just this week, nearly 4.7% just this week, just since Monday, listeners. So that's a big give back out there in the old small caps. If you're wondering what vol is out there in that June contract, it's at about a 28.5. You get closer to the front end of the curve, talking about what John was going after with the gamma portion of the curve there. That's at nearly a 36, but that contract has 1 day to go. So that vol is kind of meaningless. It's all gamma really anyway. But going out to June, a little bit quieter in terms of sanity. It's about 35 days left to go on that contract. That's about a 28.5. That's up 6.5 points from this time last week. So that June vol is threatening to break the 30 now in small cap vol, which again is hard to argue. They've been moving quite a bit. Skew wise this week, the puts last week were 18.3% rich to the at the money. So they had to have those puts this week. They need them even more, 19.4% rich to the at the money. Last week, the calls were 14%. This week, they come in a little bit, 13.1% cheap, which is kind of interesting. Usually when we're blowing down there like that, you're going to see maybe a little bit more bid to the puts because we move so aggressively, but they got 19.4%. So interesting stuff afoot out here. Let's go out to see what the paper is, because for a long time, people have been asking, what about these small delta calls? What about these small delta calls? And those are still trading, but they're not the number one with a bullet this week. It's actually 1620 puts in June, about 1,000 of those going up this week. That was the most active contract out here pretty much Tuesday and Wednesday. Most of those were closing, though, so maybe taking some of those, maybe some short puts off the table. Either way, it was, I wouldn't call them small delta, but they're smaller delta. I mean, they're not exactly 50 delta puts. So smaller delta puts here in June are the order of the day. But right behind it are the 2,200 calls, which are now small delta because they're going out in a day here. These are the May contract that have 1 day to go. So those were trading hot and heavy all week as well. Again, not surprising. That was the at-the-money strike till not too long ago. So it's kind of hard to call those anything small delta because they were in the money. Now they're out of the money. So now, by virtue of underlying movement, they have become small delta calls. But it wasn't like folks were piling into these a while ago when the underlying was much lower. So 2,200s were also active, almost all that today. About 600 today. So maybe some folks closing out what's going on there in this contract with 1 day to go. But interesting stuff afoot here in all things small caps. Speaking of vol, and before we rotate out of equities here, interesting stuff. If you guys have been listening to the show, you know CME is getting even more active in the equity vol space. Derek Salmon's been on a bunch of times talking about these CVOL indices that they're calculating, effectively a CME version of implied vol indices on your favorite products. Spoiler alert, Derek's coming back to talk about more, including these. They just announced just before the show here 5 new additions to the CVOL suite of indices. So now you can, and these are going to be multi-product kind of aggregated benchmark indices. They launched 5 more. So they have a treasury curve CVOL index now that's going to aggregate the 2-year, 5-year, 10-year, and 30-year CVOL indices. Then you have an ag CVOL index that's going to aggregate corn, beans, wheat, soybean oil, soybean meal, lean hogs, live cattle, and class 3 milk. All that together in one index. That's going to make for an interesting number. Then we got an energy CVOL index. I think you know where I'm going with this. It's got WTI, Henry Hub, Nat Gas, RBOB, and New York Harbor CVOL indices in these. The metals CVOL index is going to have gold, silver, and copper in that one. And then just a general commodities CVOL index is going to kind of be in all of the above. It's got WTI, Henry Hub, RBOB, that New York Harbor contract, corn, soybeans, wheat, lean hogs, live cattle, class 3 milk, gold, silver, and copper. All of that in one index list. It's going to be kind of like the fear index for commodities. That's interesting. So I'll be curious to pick Derek's brain on this one when he comes on the show, why they decided to basket some of these together, because these are very disparate products going together. That's going to make for an interesting calculation, I would think. So if you're wondering now, the CVOL suite, easy for me to say, up to 40 different indices across pretty much everything they trade at CME. So you can check them out over there at cmegroup.com. Well, a lot to parse here, but before we keep rolling, John, you're our guest. I'll let you decide where we hang our hat next. We talked about rates. We talked about equities. What else is on your radar this week, John?
I think the big thing too is what Fed communication is right now. The Fed's new average inflation targeting framework, where they're going to let inflation run a little hot. You know, that you know, we're going to let the genie out of the bottle just a little bit, Mark, just a little bit, is going to get tested. You know, again, kind of going back to our earlier point regarding the health of consumer and corporate balance sheets before the pandemic struck, and then what they look like coming out of the pandemic as we have an economic reopening. Look, this whole framework about maybe trying to average inflation a little bit higher than otherwise is going to get tested. And you've heard Fed officials this week continue to pound the table. Brainerd on Tuesday, Clarita yesterday, Chris Waller, new Fed Governor Chris Waller today, suggest that, look, you know what? The Fed expects us to be transitory. It's going to be transitory, and they are prepared to stare down the market. As we all know, as market veterans, staring down the market, saying you're going to do it, and actually being able to do it can sometimes be two different things. And I think that's sort of, and so Fed communication, the Fed's kind of boxing itself into a corner, you know, kind of creating a Maginot line, if you will, with the market in terms of sticking to their guns. So I'm quite sure it's going to work.
That is true out there. I'm looking here at what other products are lighting up our tape out here. Unfortunately, we've done the ags a few times lately here on the show. And of course, Bitcoin, big mover to the dark side, but not a lot of options paper to sink our teeth into. Palladium also moving a lot on the dark side here as well. But unfortunately, not a lot of options paper there as well. But we are talking a lot about inflation data. And that inflation trade tends to drive a lot of interest in the metals, especially the shiny stuff. So let's hang our hat there next.
Werewolves beware. It's time to explore the options activity in silver, gold, and other shiny things. It's time to talk metals.
All right, everybody. Welcome to the metals. Haven't had a chance to really parse metals on the show in a little bit. So this will be kind of fun. Like I mentioned, palladium off nearly 3.5%. Number 3 to the dark side. Unfortunately, not a lot of paper lighting it up out there. Silver has been looking pretty interesting as well. I know a lot of you folks have been in that silver trade. It's kind of getting lumped in there with some of the meme rally stocks. You saw SLV getting some bids, short-lived earlier this year. But now net on the year, it's been a good run for silver, up 70% out here. But off this week, we've seen most of the metals actually off this week. Let's go out to gold land, which is where a lot of people like to hang their hats when we're talking inflation trade. You know, for a long time there, over 2,000 was a big deal. Coming into today's show, gold at about 18.25 exactly, off about 6.3 points or about 1/3% on the week here since Monday. In terms of where the action was this week, about 22% was coming in the July contract. It has about 42 days to go. So let's head out there and see what's afoot. People are always talking about Bitcoin vol and how anemic it is. I've made the comparison multiple times now on this program, on the Crypto Rundown program, that crypto vol, everyone always makes the comparison Bitcoin to digital gold. Crypto vol, in particular Bitcoin, is starting to behave a little bit like gold vol has for a while, where it's kind of languishing, then it gets these short-lived spikes, and then they come right back down again to whatever level it was languishing in. We saw multiple spikes with Bitcoin, and then we saw it come off. We'll see now if this little bit of downside here at this new level of vol is sustainable, or if it's going to come right back down again. But so far, for the last month or change, it's been behaving a lot like gold vol. Let's look at gold vol right now. Out here with about 32% of the paper. Actually, I take it back. 32% of the paper actually was in June. So we're going to hang our hat out there, listeners. If you're wondering what the vol is, we're talking about Bitcoin vol being anemic in the 60s, right? Gold vol is at about 12.5, off about 1/4 point this week alone. So not a lot of paper or not a lot of vol really to sink our teeth into out here in gold land. In terms of the skew, the puts, 1.6% rich last week, 0.75% cheap. So a little bit of a swing in the puts this week. Calls last week, about 0.8% rich. So not a lot of bid for the calls or the puts really last week. It was kind of a shrug your shoulders kind of week. This week, the call is a little bit more bid, 3.4% rich to the at the money. In terms of what the action was out here, by the way, if you're wondering how much paper gold puts up, about 160,000 contracts right now. So a decent week. Again, not the most active week we've ever seen in gold, but a decent week nonetheless. And I said we're at about 18.25 right now. The June 17.5 puts seem to be leading the day out here this week with looks like about nearly 5,000 going up this week, 3,000 almost on Wednesday, 1,800 on Tuesday. The rest kind of scattered throughout the week. Both of those days biased ever so slightly towards opening. So back and forth, but biased towards opening paper on the 17.5 puts in June, which are about 75 points out of the money exactly right now. So interesting stuff here. Again, we're selling off, so a little bit out of the money puts in gold trading. Not exactly super surprising. Hot on its heels, though, were the 1,800 puts, a little bit closer to the fire there with about 4,800 there as well. The big day, actually Tuesday for those, about 1,900, almost 2,000 going up on Tuesday, 1,300 today, 1,000 or so on Wednesday, and about 500 on Monday. Most of that opening, obviously we don't know today's numbers, but most of that opening throughout the rest of the week. And then 1,875 calls. It's kind of a neck and neck this week for all three of those strikes. This is about 4,650. So right behind the other two strikes there in terms of volume. And almost all of that paper on the 1875s coming today, 3,220. That's interesting. So a lot of 1875s trading today. A strike 50 handles out of the money. It's like we have about 12 days to go. Kind of surprising. That's not what I thought would be hitting the tape today. About 1,000 traded on Tuesday. The rest of the week was kind of negligible. So yeah, 1875s. Surprising bit of action, neck and neck with the 17.5 puts and the 1,800 puts out here in gold this week. You know what else you have to do in gold, listeners? Whenever we're looking at the shiny stuff, we have to look a little bit farther out to look for those funky out-of-the-money flies that always seem to like to go up here in gold. Looks like I found one, listeners, out here in SEP. Not that far out of the money, though. It's like the SEP 2000s trading 2,400 contracts this week, and followed by the 2,100s going up 2,255 times. Maybe a 1 by 2 on Monday, 500 by 1,000, pretty much exactly going up. And then let's maybe a vertical 2,850 by about 550 on Tuesday, 2,000, 2,100. And looks like about 800 each going up again today. So both these strikes in SEP, the 2,000 and the 2,100, doing similar paper this week. I'll have to dig in a little bit more to see what's opening here, but it looks like a 1 by 2 may have gone up on Monday. The numbers are just too lined up for that not to be the case. In fact, actually looks like 500 of the 21 halves also traded on Monday. So maybe we got a 2,000, 2,100, 21 half, 500 by 1,000 by 500 going up out there, which would make a little bit more sense and not just net open short on that 2,100 strike. So again, a week, a day that ends in Y, you're going to have some funky upside in gold. And it seems like that is the case. I'm not sure what it is about gold as opposed to all other products that just loves to bring in this funky upside fly paper, but we're getting it again here this week. John, you like to watch inflation. That's been a big driver of a lot of the trades you're seeing over there at RGO, including, I'm sure, the metals. Anything light up your tape this week in gold or any of the other metals out there, sir?
No, I think the big theme for the big theme as it relates to gold, Mark and Sean, is that gold's kind of underperforming here because of the outperformance and the volatility and the craziness of Bitcoin. Bitcoin's kind of, excuse the pun. I wouldn't make it as a stand-up comedian, but Bitcoin's taking the shine. Stolen the shine from gold and silver during these inflationary pressure times. And so gold bulls, I think, are a little bit of a frustrated crowd because on a fundamental basis, on a traditional fundamental basis, gold and silver, platinum, palladium, and palladium, again, that's more of a chip play, a semiconductor chip play, and a strategic metals play. But gold and silver should arguably be significantly higher given the inflation pressures that we're seeing. But Bitcoin's taking the shine, and that's been the trade. That's been the talk amongst our customers.
I like that. Taking the shine. You saw quite the punster today. You came armed with some good ones, John. You had the shoulder-mounted missile before you got taking the shine from the metals. I see what you're doing over there. I could certainly.
I would starve as a comedian. We all know that.
You brought some good material nonetheless. Let's see if our listeners can follow suit. It is time for their futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, let's get to it. Your feedback. You guys ask us great questions. Sometimes we turn the spotlight back on you like we're doing right now. It's funny, when we posted this poll at the beginning of the week, markets were very different. Kind of back in that realm and regime today. Let's see how long it lasts. But we asked you at the beginning of the week, before all the madness popped off, we said markets were hovering at new all-time highs. Volatility was trending lower. In this environment, what is your go-to option strategy? We gave you 4 basic choices. You guys can always reply, DM with your other suggestions. We know you like all sorts of funky strategies. We gave you 4 basic ones to choose from: buying calls, buying puts, the covered call, or indeed the short put. It's about a day left in this poll. Head on over to @options to make your voice heard. I'm curious for you, John, if you have a vote in this, have at it. But B, more importantly, what are you seeing from your clients right now in this environment? And then C, what do you think our audience is voting for? 3 questions for you, sir.
No, I think you want to be kind of long. When it comes to risk assets specifically, I think risk assets equities still have to adjust a little bit more to this kind of rising inflationary story. I think you heard in corporate earnings that about 70, maybe 75% of corporations that reported, let alone Warren Buffett and the Bridgewaters of the world, are basically saying that price pressures are up across the board, and that there's more to go on this inflation trade. So I think risk assets, nearly priced for perfection going into earnings season, and earnings were strong, but the post-earnings season trade has been to the downside, and that hasn't been over earnings disappointment. That's been on the inflation fear story. And I think there's more to go there. So I think kind of being a little bit defensive here in equities by being long puts or put spreads is probably the right trade. And in a break from tradition, Mark and Sean, in a break from tradition, I think stocks and bonds, and we heard that magic word correlation earlier, correlations are starting to kind of move closer to one. And so you could see a rising yield environment, a rising rate environment, and declining equities. And that's a trade we haven't really seen in a long time, right? So it's almost the antithesis of the risk parity portfolio and the 60-40 balanced funds, right? So kind of what are our favorite trades? We like the curve steepener in rate space. We like being long 2-year notes against short the 10-year point. We don't want to be short the 30-year point because there's too much retirement, asset liability management, insurance bids at that 30-year point. So we want to be short the 10-year point, be short the belly of the curve in this rising inflationary environment. We want to be long put spreads on risk assets, and we want to be short the dollar. We think that being short the dollar is part of the Fed's strategy here, cheaping it up. We think Treasury and Fed are actually working together to sort of cheapen the dollar up a little bit. And look, given the supply of dollars that the Fed and the Treasury have pumped into this economy over the course of last year, the path of least resistance for the dollar is lower. So those are kind of our three major things. We'll be short the dollar, we'll be long put spreads on risk assets, and we want to be short the belly of the curve and the 10-year point against being long up front.
Fascinating. So I'm going to put you down here for the long puts portion of our poll. Sean, same question for you, sir. If you have a vote, have at it. But more importantly, what do you think our audience is voting for, sir?
And I'm going to lean back on a comment John made earlier in the show about he's got customers long gamma. So I'm going to be kind of leaning that way myself. I think the numbers are going to continue to be mixed. I do think that the volatility will stay healthy as it has and tradable. So I'm thinking I think you're going to have a mix, probably breaking even on buying calls and buying puts. That's my guess. Long gamma.
Wow. Both of you looking pretty savvy today here. John saying buying puts.
I think that's the right trade. I really do. Sean, I think that's the right trade.
Well, let's see how our audience feels. And like I said, both of you pretty prescient, fairly savvy today. Buying puts winning right now, 39.3%. So both of you on that tip. Following hot on its heels, though, buying calls, 29.5%. So, again, John's kind of long gamma trade certainly leading the dance. Covered calls, number 3, about 27.9%. This surprised me. No love at all for short puts, 3.3% out there. And you guys have responded with your alternatives. We love you all who want your diagonals and your flies and stuff. I wish we could give you all those choices. Unfortunately, only limit us to 4 on Twitter. So we have to keep it kind of straightforward and basic for stuff out here. Let's go to a couple more questions here really quickly here. Let's go to, actually, this is an interesting one, Sean, because you come from the broker perspective. I'd be curious to get your thoughts on this. This comes from J3 Dingle, one of our regular listeners. He wanted to know, is it ever a good strategy to sell covered calls to avoid a margin call? I thought this question was kind of interesting because on the surface, you say to yourself, why would you do that? It doesn't really accomplish anything different. You're still kind of liquid. I suppose if you migrated your covered call into a deep in the money type call, you can maybe get a little bit extra bang for your buck than just liquidating the position, but you're kind of effectively doing the same thing. And also that money's not hitting your account right away. So for you guys over there at RJO, John, if a client's about to have a margin call, does selling a covered call, does that help them at all?
I don't think so. Look, I don't think that selling volatility to make a margin call is typically the right trade. We would suggest try and find other ways to either make the margin call, but selling volatility to make a margin call can be a slippery slope. What that actually is, I think, is it takes leverage to another level by being short volatility on a margin call, and that's not something that I don't think that most of us would sort of step forward and it would be our first or second recommendations. No.
Yeah, I'd be hard pressed to think that that's going to help you out. And like you mentioned, it's adding more complexity to a situation that's already moving against you. All right. Let's wrap it up here with this one from Nichols. Nichols with a Z. That sounds familiar. I think they've written in before. They want to know, has the recent rut sell-off caused the action to flip to the small delta puts from the small delta calls? Well, Nichols, Hopefully you were listening earlier in the show because we did just break down RUT options not too long ago. And the short answer is yes. 1620 puts were leading the dance. These are many handles out of the money. These were, I believe, they were in June. So the June 1620 puts were leading the dance this week. 2,200 calls going out tomorrow were also pretty active, but those are probably mostly closing out there. So you're seeing a lot of 1620 puts going up this week. And again, those would qualify as small delta puts. So at least for the time being, those were trading. Of course, a lot of closing on those strikes this week. So maybe take some of that paper with a bit of a grain of salt. Maybe some folks had overwritten those and now they're taking them off. Maybe they bought them and thought this was going to be, they're going to get an aggressive sell off. Maybe they got as much as they thought they were going to get and they took them off. So closing paper. So bear that in mind. But yes, from a pure volume perspective, 1620 puts were leading the dance. Sean, anything to add here for Nichols? Wants to know if the skew love has flipped to the puts in Russell 2000, sir.
As I always mention, the Russell 2000, our small cap index, has the ability to outperform to the upside, and it has the ability to outperform to the downside as well. So I've always been a fan of buying puts when you can, not when you have to, as a trading strategy. But I'm not surprised as you see this index slowing down and not performing as well. It's due to the domestic nature and the weights of the index. So, but just keep your eye on economic data numbers, those domestic ones, because they're big indicators on the components of the Russell 2000 index.
Unfortunately, listeners, that music means we've come to the end of our time here on TWIFO for this week. But before we go, let's go back around the horn. John did another able job holding down the CME Group hot seat. John, if our listeners are intrigued, maybe they want to reach out to you and the team over there at RGO. They have questions about the inflation trade or all this other crazy volatility of economic data. They want to pick your brains. Where should they go? What should they do, sir?
Why don't you send me an email? I'm at jbrady@rjobrien.com. Or you can always call RJ O'Brien's main offices, or visit our website. The RJ O'Brien website is, again, another fabulous resource where you can sort of look at brokers, look at different products we offer, compare to shop us versus our larger competitors, and things like that. So the RJO website, calling the main number here, 312-373-5000, or just calling or sending me an email at jbrady@rjobrien.com, and we'll try and help you out as best we can.
There you go. He gave you his email. Make him regret it. Hit him up with questions and comments. Deluge him with your questions. Of course, you can give RJO a follow on the old Twitter machine as well, at RJ O'Brien, all one word there, for their updates and their data in between their appearances here on this fine program. And Sean, you folks over there at FTSE Russell have been pretty busy since our last show. A lot of great data coming out on why Russell 2000 is underperforming versus the Russell 1000. What's driving that? You kind of hit on some of it earlier. The different sectors, the healthcare versus the tech versus everything else. A lot of things going on, how the change in the yields and inflation is impacting all this. So a lot of great data coming out of you and the team over there at FTSE Russell. If our folks want to access all that data, Sean, where should they go? What should they do?
Well, first of all, Mark, thanks for having me on the show. And John, it is always a pleasure to be on the show with you. I learn something new every single time and I just truly enjoyed listening to you speak. So thank you again for being on the show today. It's been absolutely fantastic.
Well, it's a pleasure. You guys are a lot of fun, and you're smart, right? So it's always a pleasure to talk with smart people. And you guys are very nice to have me on. So thank you.
I appreciate the compliment. But yeah, there's fantastic data at FTSERussell.com. The blogs that were recently put out are there. So all you have to do is type FTSERussell.com/blogs, and the most recent economic data that we discussed on large and small cap Russell indexes versus the economy in the global index universe is there. So feel free to look at those blogs. And again, I always am available if you have a question. It's sean.smith@lseg.com if you want to send me a note or send me a question. Happy to help in any way.
There you go. A lot of great data. You can also give them a follow as well at FTSE Russell, FTSE Russell, on the old Twitter machine. So a lot of great data coming out there as well in between episodes of this program. You know where to go in between episodes of TWIFO. Maybe you want to run your own reports Like I said, 2 a.m. on Saturday, we don't judge. CMEgroup.com/TWIFO or /TWIO are the places to go for that. A lot of great research coming out of Eric and his team over there at CME these days about bond vol, about metals and everything else. I didn't have a chance to even get to it on the show today. Check it out over there at CMEgroup.com as well. And on behalf of everybody over there at CME and John, everybody over there in RJO land, and Sean, everybody holding down the fort in FTSE Russell Studios, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for listening live on a very tumultuous week. Stay safe, stay sane out there. We'll be back again tomorrow. You got a lot of vol going on this week. We're going to break it all down tomorrow, noon Central, 1 p.m. Eastern on Volatility Views. Then we're back again next week. The option block on Monday kicks it all off all the way through to Thursday and another episode of This Week in Futures Options.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit FTSERussell.com, CBOE.com, and CMEGroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.